A new war has just erupted in the Middle East, and believe me, the shockwaves are already hitting global markets. This isn't just some distant headline you can ignore. It has immediate and pretty serious implications for your investments.
So what was the trigger? A coordinated military strike by the US and Israel on Iran. And look, this isn't just another skirmish. This is a massive escalation, the kind we haven't seen in decades, and it's sparking very real fears that this is just the beginning of a much wider conflict.
So, the big question on everyone's mind is, what does this all mean for you, for your money? Well, we're going to cut through all the noise and give you a clear financial guide to navigating this crisis.
Right, so here's our game plan. We're going to follow the money. First, we'll look at the conflict that lit the fuse. Then, we'll trace that first major shockwave through the global oil market, see how stocks freaked out, and then, this is the important part, we'll identify the corporate winners and losers and figure out where the smart money is finding shelter.
Okay, so every market panic starts with a single spark. Let's break down the exact chain of events that ignited this absolute firestorm.
Yeah, this wasn't a slow burn at all. It was an explosion. The killing of Iran's supreme leader is a monumental event in itself, but it's the immediate, widespread retaliation across all these different countries that sent shockwaves through the financial markets. It created this very real, very palpable fear that we are on the brink of a much, much larger regional war.
And that brings us to the first and, honestly, the most powerful economic domino to fall, the threat to the world's oil supply.
You know, whenever conflict erupts in the Middle East, oil prices are almost always the first casualty. And the reason for that, well, you can pinpoint it to one very specific, very narrow spot on the map.
And that spot is the Strait of Hormuz. You should think of it as the jugular vein of the global energy supply. It's an incredibly narrow waterway, but its importance, well, you just can't overstate it.
Just get your head around this number, 20%. That's how much of the world's daily oil supply, a staggering 21 million barrels, has to squeeze through this one tiny choke point. So if you disrupt this, you're not just causing a problem, you're threatening to choke off a massive artery of the entire global economy.
And boom, here's the direct financial result. We saw an immediate 13% spike in Brent crude. With Iran being a major OPEC producer, their own exports are at risk. But the real fear, the thing experts are warning about, is that a full closure of the strait could send oil rocketing up to $120 a barrel. In fact, the market has already tacked on a $10 risk premium to every single barrel of oil just because of this conflict.
So, a spike in oil? Kind of predictable. But here's where we see the fear really go viral. It translated into a broad-based panic across global stock markets. All of a sudden, this wasn't just about energy anymore. The numbers really tell the story here. In the week the war broke out, you can see a clear negative hit to U.S. stocks, with the Dow dropping 1.8%. But notice what happened with bonds. Investors started dumping stocks and buying up government bonds, loaning money to the U.S. government, which is a classic flight to safety in a crisis. And it's not just a U.S. story. You see that same nervousness ripple through the Indian bond market, too.
And when you dig into the specifics, you see the plunge was significant and it was widespread. I mean, we're talking about a nearly 1,000-point drop in India's Sensex and a 571-point dive in Dow Jones futures. This wasn't some minor dip. This was a clear, loud signal of investor fear. But here's the thing. A falling tide does not lower all ships equally. While the overall market was a sea of red, a crisis like this actually creates a really sharp divide between corporate winners and losers. So let's break it down. Who sinks and who swims?
All right, first up, the losers. These are the sectors that are just the most vulnerable when oil, a primary cost for them, skyrockets overnight. The list just makes sense when you think about it. Companies that sell fuel, their profit margins get crushed. Industries that use crude oil for their products, like paint and tire makers, their costs just go through the roof. Airlines, they get a double whammy. Higher fuel prices and flight cancellations. And then, of course, you have companies with direct exposure, either through big projects in the region or because they actually own assets right there in Israel. But it's not all bad news for investors. Actually, certain industries tend to thrive on this kind of uncertainty. They see a surge of interest when geopolitical tensions get this high. And this is the other side of the coin. Defense stocks. They're often called a geopolitical barometer. Basically, when conflict breaks out, they tend to go up. The upstream oil producers, the companies that are actually pulling the crude out of the ground, they benefit directly from higher prices. And often, a rally in oil spills over into other commodities, which gives a nice boost to metals companies too. So, this all leads us to the most important question for any investor watching this unfold. With all this volatility, where on earth do you find shelter from the storm?
And this quote from an investment strategist really drives home the point we just made. In a fearful market, the money flows to sectors that are either insulated from the crisis or, in some cases, even benefit from it.
So, based on market analysis and what's happened in the past, a few key asset classes and sectors emerge as the go-to defensive plays during this kind of turmoil.
So here's the list of potential hiding places. Gold is the classic choice, and right on cue, we saw it jump to a one-month high. We've already talked about upstream energy and metals. But you also see money moving into classic defensive sectors. Take IT and pharma, for instance. They're seen as safer because, well, people still need healthcare and tech services no matter what the price of oil is. And some analysts even see value in private banks, mainly because their prices were looking pretty cheap heading into the crisis.
You know, historically, markets tend to bounce back pretty quickly from geopolitical shocks. They cause sharp, short-term pain for sure, but the system usually recovers. That's the historical pattern. But with the leader of a major nation gone and the conflict escalating by the day, you really have to ask yourself the uncomfortable question: what if this time is different?